Good morning and welcome. I'm Mohini Naidu, Senior Investment Analyst at Ned Group Investments, and I'm joined today by Stephen Romick, Co-Portfolio Manager of the Ned Group Investments Global Flexible Fund. In spite of continued bouts of volatility, investors in global markets will no doubt be quite pleased with the returns delivered by the likes of the MSCI World Index last year, which was up just shy of 22%. Now, while the Global Flexible Fund didn't have as robust a return as the overall market, at 13.5% for the year, it still managed to capture a healthy proportion of the market's run. Steve will be talking to us today about some of the drivers of those performances over the fourth quarter and calendar year 2021. He will also share the team's thinking into how they're attempting to position the fund so as to avoid a permanent impairment of capital should markets take a downturn from here, as well as have the ability to capture sufficient market upside to deliver on the fund's growth objective through a full market cycle. Now with that, Steve, a very warm welcome, and over to you.
Thank you very much, Mohini. Thank you for taking the time, everyone, to listen to the year in review for 2021. As you know, by way of background and as a reminder to people, the objective of the fund is to deliver an equity-like rate of return, and to do so by assuming less risk across the portfolio. Most importantly, to avoid a permanent impairment in capital. Temporary marks in the portfolio are not as much of a concern, to us, particularly being mindful of trying to deliver on that equity rate of return over time. So, to that end, we are able to invest across the capital structure by both, equity and debt. Although equity has really been the focus in the last number of years because high yield bonds and corporate bonds in general have really not offered much of a return. You've got very, very low starting yields, lower still today than they were, even 5 years ago, and you have, risk of default, particularly as it relates to high yield. If you look at the portfolio's, asset class composition today, the equities are about 73%, higher than a year ago and higher than we've been historically. Bonds are much lower. We have hardly any exposure to bonds today, and average historically has been in the low teens. And what's happened, of course, is again this terrible opportunity set, that we see there. So we put more of the risk into the equity side of the equation because one of our larger, concerns as we think forward is this higher rate of inflation. Now, inflation has ticked up dramatically, more so in the U.S. than it has in Europe. But we were approaching, approaching 7% at the tail end of 2021 in inflation. And our goal when we think about risk is a host of things, not just losing money, but it's also not delivering a real rate of return over time. So real rate of return means a return, net of inflation. So try to protect your portfolio and our portfolio with our capital invested alongside in the strategy against the vigors of inflation today really requires us to be more invested than we otherwise have been in the past when we were less concerned about inflation and we were getting relatively high yields on our cash, which we are not getting today. The number of equity positions hasn't changed dramatically. We're about 50 positions and change, not including a vast number of SPACs that we have in the portfolio. The asset allocation, if you look at this slide, shows that financials still represent 17.5%, although down from where they peaked. Financials, particularly asset intensive financials have declined in the portfolio. There's been a couple of positions that have been sold out entirely, and other positions that have been lightened up as a result of these stocks having worked out in valuations reaching higher levels, and the prospective risk-adjusted return not being as attractive as we would have hoped. And there's also been some shifts, even though you see these sectors, breaking out here, technology, for example, technology, information technology, these are, broad catchphrases. Just because you say technology, you have different kinds of businesses within there. Just because you say financials, you have different kinds of businesses. You have a Wells Fargo on the one hand, asset intensive. You've got an Aon on the other hand, that's a services company. So again, different kinds of businesses are reflected within these asset allocations that you see on this page. The geographic composition, what we really focus on is the second column that you see on this slide, which is the country of the source of the revenues. And you can see that the majority of the revenue streams of the companies that we hold in our portfolio fall outside of the United States, almost 60% of the revenues are coming from outside of the U.S. So despite the country of domicile today, 2/3 of companies are within the United States. And again, that number is slightly, I believe, overstated because it includes, SPACs in there, which we look at as a different kind of investment, as we discussed on previous calls. But we still, find a lot more opportunity outside of the U.S. of late, even though you see this large domicile impact here of 67% in North America. You see, again, across the world, we see more of our portfolios in Western Europe and a smaller amount, sub 10% in Asia Pacific, including some China investments as well within that mix. The portfolio's performance, over the last year at 13.5%, compares favorably to the performance indicator, which is more of a balanced index, but certainly, as Mohini's pointed out, is not at the same level of the broader global indices over the recent period of time. It's about in line with the world value, 9% versus 8.9%. We are value investors. I think value to us is simply to suggest in the non-traditional sense that we are looking for a margin of safety. Price matters, and that is something that is the bedrock of our investment strategy. So just because something is a good business, everything has a price. So we're very sensitive, to that. So we've been able to do as well as the World Value Index over time, with a lot less exposure, to stocks along the way as well. Performance contribution, if you look in the trailing 12 months, it's fair if you look at I don't want to focus on the quarter to date because that's more noise. So I'm looking at the bottom half of this chart in the trailing 12 months. You'll note that we've got, financials had a big rebound within that. AIG was a big contributor. Those longer-term shareholders have certainly, been along with AIG right for us for quite a long time. Had a good year last year in its stock price performance, and it's been delivering on expectations. And it's finally getting some greater acceptance, by the market as a whole, and by that I mean by investors. Jefferies Financials is a position which is another financial that's worked out exceptionally well. Was a big deliverer of returns for 2021, and that position size, along with AIG, has been reduced somewhat. On the technology side, we've got Alphabet, Broadcom have been were big drivers of return. Obviously, very different types of technology companies. And lastly, we have Glencore Financial, or Glencore PLC, which is one of the largest global commodities-based businesses involved in trading, private equity, venture capital, lending, and owning mines, various kinds of mines around the world. That's been a long-term holding of the Global Flexible Fund as well, and that's something that has done well and continues to do well. In terms of the detractors, in the portfolio, you'll note that there's a little bit more Asia influence in the detraction side. Sitting at the top of the list, the three: Alibaba, SoftBank, and Nexon. And then we've got Prosus also, which is technology based in Europe. Have been, a drag, laggards, to some degree within the portfolio, but we've actually been increasing positions in a number of these different businesses that have been laggards in the portfolio, and we have a larger exposure to gaming, today in the video gaming in the portfolio. Nexon is just one gaming company in the portfolio. We have a host of other companies, in the portfolio as well today, including Activision, Ubisoft, and others. Moving on. You'll look at the one of the reasons why our exposure is not more invested than we are is really the elevated valuations we see around the globe. Although you will note here, and this is just one way to look at pricing, which is to look at valuations as a percentage of GDP. So you look at U.S. valuations of the stock market as a percentage of GDP, and you look at the world as a percentage of world GDP. And you can see in this one measure that the US is at an all-time high, and you can also see the world is at a high. But note importantly that the gap between the US and the world is wider than it's been in the past. And that is one of the things that has pushed us more directionally to own companies outside the United States because of that better valuations that we're finding there. So if you look at the 12-month forward earnings and look at the valuation of the U.S. versus the international stocks ex-U.S., the ACWI ex-US, you'll note that the forward PE is about 23 times the S&P 500 as of December 31, and for the ACWI ex-US is only 14.5 times. So you have this significant discount that exists as a starting point, for companies, to own companies outside the U.S. About a 40% discount is exhibited, on this slide. This is the widest discount that we've seen, in going back, to 2000, as displayed, on this page. And this is important, to understand is that just because they're cheaper doesn't make them better businesses, but just because the U.S. is more expensive. Just because they're cheaper in Europe, let me restate that. Just because they're cheaper in Europe doesn't mean one should own them. They might not be better businesses, but just because these companies in the US are more expensive doesn't, make them better businesses themselves. So our job is to go and discern, what is the better business and what is the right price for those businesses that we own both domestically, and abroad. And interestingly, today with this 20-year low, with these companies trading outside the US, it just points to a larger margin of safety outside the US. If you can find good growing businesses, there's been this belief that American companies are more special, that they're the only winners in the world, and that's just not true. There's very, very good businesses around the world, US, Asia, Europe, etc. And but to be sure, I think it's important, US companies' earnings have grown faster over the past decade, but that's been accounted for by an expansion of the valuation premium for these US companies. And that higher starting valuation that you see on this page dulls the future, return advantage. And in addition, the dividend yields outside the US are on average 1 point higher than they are in the US, around 2.5% versus 1.5%. So you have this nice head start by owning US companies, all else equal, by having a lower valuation and having a higher dividend yield. But of course, all else isn't equal. It really will come down to the quality of these businesses that we own in these different markets. So we're agnostic as to country. We really look for the best businesses at the best prices. And one of the drivers of this, of course, has been, for growth companies, has been low rates. And so not just more growth, but there's been, low interest rates. And low interest rates makes a future stream of cash flows more valuable. And if those cash flows are coming further out into the future and they get discounted back at a very low rate, then the stub value, what's left today, is higher. If rates go up, that stub value is lower. That's been one of the impacts in the market that we've seen in the last few months, particularly to these growthier companies, has been this impact of rates increasing in the United States in particular. So that's the end of my prepared remarks. I'm going to turn it back to Ned Group Investments and Mahaney to spend a little bit of time with Q&A.
Thank you, Steve. Thanks very much. That was very insightful. We do have some questions here submitted from investors. We saw that December was once again a strong month as stocks climbed higher and individuals and institutions alike continued to buy, perhaps fueled a little bit by greed and speculation, which drove prices even higher. However, the broad index gains belie the fact that many individual stocks have not fared as well. Forbes is quoted as saying that 93% of the S&P 500's constituents experienced a sell-off in excess of 10% last year. So a big question on investors' minds today is whether some catalyst, whether it be federal policy or that of other central banks around the world, a slowdown in economic growth, or some COVID-related or other unforeseen variable, is likely to drive a bigger sell-off in the stock market than what was experienced in the sporadic volatility of 2021. So do you and the team share any of these concerns at this point?
Well, I think there's always there are always going to be sell-offs. There certainly will be larger sell-offs than what we saw in 2021. And there'll be years like points in time like the first quarter of 2020. And that's always going to be the case. For us, we really try and focus on what we own, the price we've paid for it, and what it will look like 5 years from now and 7 years from now. And not just the market, but for the most importantly, just a starting point for the business. we have a better ability to understand what a business might do and how that might perform as a business itself over 5 to 10 years than we do what the market might do. So there's a lot more factors that will that will affect the market than just any one business. So we really want to focus on buying good businesses that we expect that are going to be earning more money and therefore become more valuable, 5 to 10 years hence. And the market's going to do what it's going to do along the way. There's going to be, there's fear of higher rates today. Partly as a function of the economy's, fear of people getting overheated and inflation, et cetera. But we've been living with easy money for a long time. We're now going to be paying the price for that easy money over the last decade plus, where governments have been borrowing money hand over fist, where rates have been very, very low, and countries have been treasuries of countries have been printing money, like crazy. So how that manifests itself in inflation is not going to be exact. I think the higher rates of inflation that we've seen, particularly in the U.S. in the last quarter, are probably not going to be quite as high as that, because there's some temporary, cyclical impacts in that, including supply chain issues. But there are other things that are more structural, and the labor market, is very, very tight, in certain parts of the world. And so there's been lots of labor inflation as well. So where that ends up, we don't know, and how that moves along the way and how people perceive that it might unfold is what's going to create that volatility in the market that you're talking about. And that all of those things are well beyond our control to understand how they manifest themselves and when they might manifest themselves. So the how, and the when are very, very difficult, to ascertain. So we just don't really try. We just want to own, these businesses where we believe that will Alphabet be Alphabet in 10 years? Will they earn more money than they earn today? Will they earn more money, and will the valuation that you're paying today still justify, the price, to keep it within the portfolio today, such that you can make a reasonable rate of return over the next 5 to 10 years? And that's really the thought process that we engage in as we assemble this portfolio for ourselves and you.
Great, thank you very much. From one of your earlier asset allocation slides, we saw that you maintain a fairly significant exposure to financials, even though you mentioned that you've lightened that somewhat, and tech stocks, some of which are included in communication services within the portfolio. Is this a theme that investors can continue to expect to drive returns over the next 3 to 5 years, say, or are you looking to other sectors such as healthcare perhaps to come to the fore?
Well, we've spent a lot of time in healthcare. We don't have much in the portfolio to show for it. Valuation has been very, very high, disappointingly. But in terms specifically to the first part of the question, will financials be a driver of performance prospectively? I don't suspect they'll be as much a driver of performance as they have been, retroactively. That's why the position in the portfolio is not as large as it was, and we've seen certain companies taken out of the portfolio, including CIT and Bank of America, and other positions in the portfolio, reduced. So we don't think it's going to be as much of a driver prospectively as it has been.
One of the early success stories in your career was your exposure to small cap stocks in the late 1990s. Now, while positive, we saw that small and mid cap stocks lagged their larger cap peers last year. Are you and the team looking for potential opportunities in these spaces again? At the moment, you have a fairly large proportion of the portfolio in large cap still.
Yes, small cap stocks and mid cap stocks, and they move up and down together, small and mid. The market moves up and down together, and at points in time, large would be better than small would be better than large, et cetera. But we are always looking at companies across the spectrum, market caps, and we do have some small companies within the portfolio today, and we'll continue to look at more opportunities in smaller cap opportunities. And as some of these companies, when they do have some of these blow-offs, the question in the market, these big drawdowns, the question that becomes at that point in time, where is the better opportunity? And I think that small cap stocks do offer some opportunity. We do have some in the portfolio today. We do expect, would like to have more in the future, but again, it comes down to quality of business, and a price you pay for it. So the world is our oyster, so to speak, and we are open to looking at everything. And small caps, I would expect to be a larger portion of the portfolio at a point in time where they shouldn't expect them to be. I would say they could certainly be, as a function of, again, price and quality.
Thanks, Steve. I think we have time for one quick, slightly tongue-in-cheek question that we may have asked you previously. Your opinion on cryptocurrencies. Has any of your thinking changed there, or is this an area that you and the team might be tempted even just a little bit to explore further as a potential source of returns?
Yeah, I'm not the best person to ask about cryptocurrency. I mean, if I think to ask somebody who hasn't owned it and owned Bitcoin as it's gone from 5,000 to 60,000 back to 40,000, who's missed that whole run. I just clearly we have not exhibited any great capability to understand what cryptocurrencies, or certainly Bitcoin in that example, really might be worth and how they might perform in the future. I don't. We have the view that cryptocurrencies are certainly, a thing, for want of a better word. But to call them a currency when they don't have the stability of currencies is I think a misnomer. So how one should value these various cryptocurrencies, whether it be Bitcoin, Ethereum, or whatever else, is beyond our capability. So even though we think that they have a reason to exist, we think they're real, but I don't know how to value them. And nobody in our team really has exhibited any great expertise in trying to, as we've talked about it and thought about it. But is Bitcoin worth 60,000, 50,000, 40, 25? I mean, I don't know what the right number is. But at the roots of cryptocurrency is really the development of blockchain, and blockchain is going to be used across various industries. And that's something that's going to be significant, in the future. It's going to benefit many of the businesses that we own.
Great. Thank you very much, Steve. On that note, thank you again for joining us today. Thank you for your time and for sharing your insights with us. We wish you a happy, healthy, and prosperous new year.
Thank you. And likewise to all of you.
Thank you very much. And thank you, as always, to our investors for joining us on the call today and for your continued support. We wish you and your families a safe, healthy, and prosperous new year.